Hi, thank you for tuning in. I'm Luisana Swager, bringing you this Markets.com special report on the credit crisis. Many people do not think of the credit crisis as something that is affecting the everyday American, but the fact of the matter is that this crisis did start to affect everyone. With credit markets seizing up, it became very hard to lend. Therefore, big banks were not lending to each other. This problem had a cascading effect as the big national banks have relationships with regional and local banks and provide them money when needed. Regional and local banks are then the ones who allow small businesses to borrow money to meet payroll and pay for inventory. With small businesses not being able to obtain money for those expenses, they would be in trouble and stop providing jobs. Meanwhile, credit was becoming difficult to obtain by everyone, in some cases making it impossible to buy a car or a home. Even individuals with good credit who were applying for credit cards were being denied or offered higher interest rates. The reality is that credit availability is essential to the functioning of our economy. The liquidity in the credit market will ease the availability of lending for those who need to borrow, and it will help people make the purchases that make our economy move. The bailout plan's main goal is to add liquidity and a bit of risk appetite in the credit markets. A few weeks ago in the credit markets, there was a flight to safety which increased the borrowing costs for all debt instruments except U.S. Treasuries. The bailout plan is meant to get people out of U.S. Treasuries and into money markets, commercial paper, and corporate bonds. Once people start buying into these instruments, we will see all interest rates in the economy start to drop. In the last few months, LIBOR, Prime, 10-year, and 30-year mortgage rates have been creeping up. The bailout plan is intended to bring these rates back down to make it more feasible for people to start borrowing again. Bank injections are going to add much-needed capital to financial institutions. In turn, this will bolster the confidence that both the market and counterparties have in them. The Troubled Asset Relief Program will allow banks to sell assets that at the moment are very hard to value. The money from these proceeds will allow banks to shore up their balance sheets and lend money. The stock market is helped by the plan because better capitalized banks mean higher market values. It also means that a lack of confidence won't erode the value of financials any further. Also, as the possibility of a collapse of the financial sector is taken out of the equation, investors will go back to looking at the economic and earnings data. The economy, however, was already in bad shape before this and will probably continue to be, as it appears to be headed into a recession for at least the next 2 quarters. The bailout plan is not going to stop that, nor was it meant to. This plan is far from being a long-term solution. It is simply a plan to fix the acute problem that was occurring with the lending in the U.S. and worldwide. It is a plan that will surely ease credit tightness over time, and as it does, it will allow people to focus on what is going on in the rest of the economy. That brings us to the end of this Markets.com special report on the bailout. I'm Luisana Swager. Thank you for joining us. See you soon.